The common image of an IRS collection is a subjective negotiation with a bureaucrat, sifting through a disorganized pile of notices for a middle ground. The Internal Revenue Manual actually dictates a 25-week automated sequence. This is a pre-programmed algorithm known as the Automated Collection System, or ACS. The agency has operated as a massive data processing machine since the era of reel-to-reel computers. Today, that processing power forms a rigid pipeline that responds to systemic triggers, not stories. If a taxpayer simply ignores the notices generated by this automated sequence, the algorithm does not pause or reconsider. It simply advances to the next node in the pipeline. Passive avoidance allows the algorithm to advance towards its final objective, asset seizure. Without a specific procedural intervention, the system automatically bypasses the voluntary resolution windows built into the early stages of the pipeline. To understand how to intervene, we are going to map the exact progression of this algorithm, from the initial CP14 assessment notice to Phase 4 enforced collection. Any leverage in a tax dispute depends entirely on identifying exactly where an account currently sits within this 25-week sequence. This timeline begins at the first node, the CP14 initial demand. This notice fulfills fund level requirement under Internal Revenue Code Section 6303. It establishes the baseline debt and starts a 10-day countdown before a statutory tax lien arises against your property. As seen in this IRS correspondence guide, these notices are hard-coded systemic actions triggered by specific database conditions. They are not custom letters typed by agents. If the CP14 is ignored, the timeline automatically progresses, generating the CP501 and then the CP503 notice. During this phase, the IRS database shifts the account into an active collection status. This active collection phase is the optimal window for a voluntary resolution. The system is demanding payment, but it has not yet authorized physical enforcement. That window closes with the arrival of the CP504 notice, the final automated warning. At the CP504 stage, the system's authority shifts, explicitly granting the IRS the power to seize any state tax refunds owed to you. This automated notice stream is a legal countdown. Every week of inaction systematically closes off voluntary resolution windows until the system forces a mandatory response. The definitive boundary line between the automated stream and physical enforcement is the final notice of intent to levy, issued as either an LT11 or a letter 1058. The issuance of this letter triggers a strict 30-day statutory window. Within this window, the taxpayer has the right to request a collection due process, or CDP, hearing under Internal Revenue Code Section 6330. Filing for a CDP hearing physically transfers control of the account out of the automated collection system. The case moves to an independent appeals officer, shifting the venue from an automated pipeline to a legal review. This transfer triggers a legal mechanism known as tolling. Tolling creates a legal stay on the automated seizure machine. The IRS is prohibited from issuing levies while the hearing is pending. At the same time, tolling suspends the 10-year collection selection expiration date, pausing the clock on the IRS's legal timeframe to collect the debt. Submitting a CDP request within this 30-day window is the specific procedural step required to move an account out of the automated sequence. It is the only input that creates a mandatory stay on seizure actions while an independent review takes place. If that 30-day window expires without a CDP filing, the automated protections vanish. The account plummets into Phase 4, enforced collection, where the relentless algorithmic system officially initiates physical asset recovery against the taxpayer's property. Enforcement takes two main forms. A federal tax lien is a public recording that secures the government's priority over your property, while an active levy is the actual seizure of those assets. For example, a Form 668A levy hits your bank account. It enforces a mandatory 21-day hold on the funds currently on deposit before they are transferred to the Treasury. Alternatively, a Form 668W levy executes a continuous garnishment on your wages, pulling directly from your paycheck every pay period until the debt is cleared. To bypass Phase 4 enforcement, you have to use Phase 5 tactical resolutions, specific procedural off-ramps coded into the system. This flowchart maps a tactical off-ramp, the first-time abate waiver. The system runs a compliance check. Does the taxpayer have a clean history for the past 3 years? If yes, and there are fewer than 4 penalty codes, the algorithm grants relief. The FTA has a specific limitation. While it removes the penalties, the unpaid tax principal and its associated interest remain. Other off-ramps have their own logic, like structuring an installment agreement, settling via offer and compromise, or proving current not collectible hardship. Achieving tax relief relies entirely on meeting these rigid systemic criteria, inputting the correct logic into the machine, rather than hoping to win a subjective negotiation with an agent. This complete diagram shows the entire 25-week pipeline. The initial CP14 trigger leads directly towards Phase 4 execution, interrupted only by specific statutory gates and procedural off-ramps. There is a direct inverse relationship between the time an assessment sits in the system and the leverage available to a taxpayer. Your leverage is at its peak when the CP14 arrives. It drops significantly once the LT11's 30-day window closes, moving into physical enforcement. The core duty of effective tax representation is navigating this exact timeline. That requires diagnosing exactly where an account sits chronologically before taking a single action. Once the position is known, you can deploy the correct statutory mechanism, whether that is a CDP, an FTA, or an installment agreement, to stay the system and dictate the terms of resolution. Because the IRS collection algorithm is predictable, rights are only lost when a taxpayer mistakenly treats a pre-programmed machine like a human bureaucrat.